Hello, everyone, and welcome. We are going to pause just a minute or two to let everybody cycle in because we have a lot of attendees today, and then we'll get started. Okay, looks like people are rolling in. Just so you know, we have over 1,200 attendees today, so we're kind of getting the feeling that this topic is important to y'all.
Just a little.
Just a little. All right, let's officially get started. Hello, everyone, and welcome to GASB 96 Lost in Translation Implementation Challenges No One is Talking About. On behalf of LSL and DebtBook, we are really glad that you joined us this afternoon, so welcome. Now, before we get started, a few quick housekeeping items. This webinar is eligible for 1 hour of CPE credit. We're going to launch 4 polls throughout the presentation. So to receive credit, you must answer 3 of the 4 polls and also complete the short evaluation you will receive afterwards. The email evaluation will be coming to you from a company called Prolera, so be on the lookout for that in your inbox later today. Also, this webinar is being recorded and you'll receive the recording link and the slides emailed to you later today. So be on the lookout for that in your inbox also from LSL. Now, lastly, this webinar is going to run 50 minutes. Kelly and Kasey would love to answer all the questions that come in, but because we have over 1,200 attendees on this webinar, they're not going to be able to answer all of them. However, we still would like you to put any questions you have in the Q&A box, and we'll look for similar questions that come up, and we'll try to answer those that we can. All right, let's get started. Take it away, Kelly and Kasey.
Hi, thanks everybody for joining. My name is Kasey Harris. I am the VP of Accounting Product and Enablement here at DebtBook, and I will be presenting along with Kelly Telford, who is a partner of government services at LSL. For our agenda today, we're going to do an overview of GASB 96. We're also going to clarify some of the things that we've been seeing through GASB 96 implementations for our customers and clients. And then we'll also cover the implementation guide that was just issued earlier this month that includes some GASB 96 questions on it. Our learning objectives for this session. After this session, you should understand how GASB 96 and GASB 51 interact. You should be able to identify project costs and understand how they could affect materiality. You should be able to navigate through more complex SBITA scenarios. And you should be familiar with the SBITA questions from the most recent implementation guide 2023-1.
All right, Kate, you want to have, there we go. All right, let's start out first by talking a little bit about what GASB 96 was trying to do. We've talked a lot about the GASB 87, the leases being very similar to SBITAs, but the reality is they're much more similar to GASB 51 for intangible assets, in my opinion, than I think they were for GASB 87, particularly because a lot of our clients, GASB 87 was much more prevalent for the lessor leases. A lot of our agencies still had lessee leases, there just weren't as many. So back when GASB 51 was implemented, it really focused on internally generated software where you purchase a license and you configure that software, think of your ERP system, to be able to use maybe for the next 20 years. Over the last handful of years, software companies have changed to more of a subscription model where instead of you paying that huge outlay up front, you're actually paying it over time on a subscription basis, say, $50,000 a year instead of a couple million up front. When GASB implemented, or when GASB wrote GASB 87 and GASB 94, they realized that these software subscriptions acted very similar to lessee leases. So ultimately what came about was a marriage, a baby, as I like to call it, a baby from GASB 51 and GASB 87. So you can see in this slide, the asset side really follows the accounting for intangible assets, very similar to intangible assets, but the liability piece really follows the GASB 87 methodology where you calculate the net present value of the lease payables. Next slide, please.
Okay, now let's discuss some clarifications that have been determined based on entities working through this implementation process for GASB 96. Let's start with subscription term. So GASB's included a number of caveats around calculating the subscription term, which can make it a little more complex than it seems on the surface. So here you can see that the standard states that periods for which both the government and the SBITA vendor have an option to terminate the SBITA without permission from the other party, or both parties have to agree to extend, are cancelable periods and are excluded from the subscription term. This means to be excluded from the calculation of the subscription term, both parties have to have the option to terminate without permission from the other party. This is a key point, though, without permission from the other party. If one party cannot cancel without the other party agreeing to it, that portion of the subscription term should still be included. So think about your rolling month-to-month or year-to-year agreements that have a holdover period. They're excluded if both parties have the option to terminate at any time without notice. This is going to be important to remember when we cover the new implementation guide later, because GASB clarified that automatically renewing options are included in the subscription term and are not considered perpetual licenses that can be excluded. Many of our clients and customers have been confused around what qualifies as a short-term SBITA. The standard states that a short-term SBITA has a maximum possible term under the SBITA contract of 12 months or less, including any options to extend, and that is regardless of the reasonable certainty or the probability of it being exercised. So when you're evaluating your subscription term, remember all extension options are considered part of the maximum possible term. It doesn't matter whether you're reasonably certain that you will not take those options to extend. They're still included for the determination portion. So for example, if you have a subscription contract with a non-cancelable 12-month period, but then it has options to extend in 1-year terms for maybe 4 extra years, this is still going to be considered a SBITA, even if you're reasonably certain not to use those extensions. Now we're going to launch our first polling question. Because of the number of participants and the amount of content that we have to go through, we're going to keep that polling question open for now, but we're going to continue on with the content of the presentation. Other charges. So you might see maintenance, support, or other types of annual charges. And we've had a lot of questions around what to do with those charges. So most of them are just going to be expensed as they're incurred. But one of the items that we wanted to point out is that in some instances, we've noticed where maintenance or support is an annual recurring fee. And without paying that fee, you lose access to the software. It doesn't matter if it's classified as maintenance or support, if losing or not paying those fees will result in losing access to the software. So keep that in mind when you're considering the charges that you are classifying for a SBITA.
All right. So like we had said, a lot of these are coming from questions that we've received through implementations that Kasey and I have been doing. And then questions that we've also received from the audit side, questions that we've gotten from our clients on whether or not they would still qualify. And this is one of them. What happens if we prepay the full subscription payments? Say it's a 3-year subscription term and we pay all of that up front. Is it still considered a SBITA? The answer is yes. The prepayment does not change the definition of a subscription in general. So in paragraph 6, and you can see, because I know all of you are asking for the slides, I can see them all popping up. We've tried to be very intentional to give you guys the guidance directly from the GASB. So all of these are snips directly from it. You can see in the definition of a SBITA, nowhere in that definition does it talk about the timing of the payments, whether the payments are made up front, if it's partial, if they're all made on the back end. Regardless of the payment terms, it is still a subscription and it still qualifies under GASB 96. The reason I want to say that this is important, and we've actually, I know Kasey's talked to me a lot about this. She's hearing 2 different types of advice from different firms as well. The reason I want to say yes and still include it in your organizers is because if there's a modification to it, there's a lot of other things you have to consider for the actual disclosures, for even if you're looking at the prepayment. So say you entered into this agreement 2 years ago and your transition date is July 1st, 2022. Technically, if you're following proper GAAP guidance, it should be sitting as a prepaid on your balance sheet. Well, it shouldn't be a prepaid on your balance sheet because technically you've prepaid that liability and now you need to record that subscription asset. And the subscription asset is going to equal what you've already paid plus any other out-of-pocket implementation costs, which we'll go over in a few minutes. I think it's really critical. I'm probably jumping ahead, Case. I think I'm on the next slide now that I think about that. It's really critical that you truly incorporate all of the factors for that particular subscription, not just the fact that you prepaid it and don't have any additional outlays for the subscription term itself. So one of the things that you should also consider is when you go in to pay for implementation costs, you probably didn't record those at all. You probably prepaid the subscription and either it's sitting as a prepaid or you expensed it in the fund and that was it. Well, don't forget, you're going to result in an asset that's going to be amortized over the life of that term. So in that 3-year example, it's going to amortize over those 3 years, which is likely going to be different. Even if you considered that under GASB 51, you could have very, very different results. We'll go into a really in-depth example of this a little bit later on, but again, it does qualify as a subscription. So increases in prices for option years. What happens if it's not based on an index? If the price increases, I saw this under leases a little bit when it came to enterprise and the lessee leases for vehicles. It's possible you're going to see this too. What happens if the price increases along with you exercising an option period? Maybe it's subject to negotiation. Maybe the contract says that it needs to be agreed upon by management and the software company. How should the payments be valued? Just like GASB 87, you value it based on what you know. Remember that concept of minimum rent? Very similar. So the subscription liability is going to be calculated on, so it's your transition date. If you're a June 30 year end, a December 31st year end, we have a lot of June 30th clients on. Your transition date is July 1st, 2022. Unless you present comparatives, then it goes a year back. So whatever your base payments were at that point in time, you don't actually revalue them from that point forward. In that second piece, do we make any adjustments? Paragraph 21 specifically says that a subscription liability is not required to be remeasured solely for a change in an index or a rate used. So value it once, so long as there weren't any other modifications to the contract, then you don't have to revalue it. So what happens if you have increases based on an index? Say you're reasonably likely to exercise the extension options and it's based on something like CPI. So I'm going to have you perk up your ears here because I think most of my clients got this wrong for leases. It applies to leases, it applies to GASB 94 for P3s and SCAs, and it applies here. If it is based on an index and your transition date is July 1st, 2022, you are supposed to go back in and use your CPI as of the transition date as your estimate for your future increases in minimum rent. So if you have an agreement that increases annually by CPI and your CPI for July 2022 is 4.8%, then that's what you're going to put into DebtBook, or what DebtBook, if you chose the white glove service, what DebtBook is going to put in for you. But you're probably going to have to tell them that. Then if it's different than that, say the actual CPI is 5.2%. That actual difference, next slide, Kasey, That actual difference ends up being captured in the footnote disclosures. So that 4.8% that we estimated, say the minimum rent payments were $5,000. That is going to be used to value your liability. And you're going to reduce the liability by your principal payments every period. But if that increase happens that's more or less than what you estimated, the GASB says that you basically take that to your current year expenses. And ultimately it results in this footnote disclosure. So you can see paragraph 60C talks about the outflows of resources recognized, and then the variable payments not previously included in the measurement of the subscription liability. Because it's going straight to the income statement, you don't have to worry about remeasuring it. All you do is disclose it in your footnotes. So just to make it easy for you guys, I put an example in here that reads the amount of expenses recognized during the fiscal year for variable and other payments not previously included in the measurement of the subscription liability was blank. We have a really good footnote example that we used for leases. We'll probably use a very similar footnote disclosure for subscriptions because they are very similar. All you're really going to put in that blank is the difference between the cash that you actually paid versus the reduction of the liability. It should naturally be that delta between your CPI.
Okay, now let's talk about modifications and terminations. It's really important to understand the difference between a remeasurement and a modification. A lot of our clients are thinking about this right now. If you're on DebtBook, we just recently rolled out our change management functionality, and so a lot of clients are facing these kinds of questions. Modifications are for amendments that are actual contract changes, not just changes to circumstances that are already in the agreement. In order to trigger a modification, the agreement would have to be modified so you would have new signatures for that agreement. So in the standard, you can see that it states amendments to SBITA contracts include changing the contract price of the arrangement, lengthening or shortening the subscription term, adding or removing underlying IT assets, and changing the index or rate upon which variable payments depend. And that doesn't mean the rate itself changing. So Kelly referenced the CPI increase. It's not that rate changing each year. It's if you stopped using CPI and started using a different type of index, for example. So an important note here is that if an amendment reduces the right to use the asset, it should be considered a partial or full termination, because this is similar to impairment of the intangible asset. And if you look at the last sentence of this paragraph, you can see that they're referencing exercising an extension option using guidance in paragraph 12. So we're going to take a look at paragraph 12. So this year, it's unlikely that you'll have to worry about reassessing the SBITA term, but this also applies to leases. And now that you're in your second year of leases, we thought it would be important to go ahead and cover this. So if you look at 12A, if you did not expect to exercise an option, but you ended up exercising it anyway, then you need to reassess the term and determine that new final payment date. This means that you're going to have an addition to your SBITA asset and your SBITA liability in the year that this reassessment occurs. We've heard some of our clients think that once they're done with the term, they can just record the transactions on a cash basis. But if you think about it, think about your ERPs, for example. If the term ends and you don't make any more payments, then in theory, you're likely to lose access. So you likely actually did exercise an option to extend, or you have a new subscription altogether, or potentially you switch to a new software. And either way, in any of those scenarios, there's a liability that exists that you need to make sure you're capturing for your financial statements. Conversely, in 12B, if you thought you would exercise an option to extend and you didn't, you probably terminated the agreement. And so this is going to result in a disposal of the asset and writing off the remaining subscription liability. Keep in mind, if you have any agreements that fall under 12B, you likely replaced it with another software or something else. So you want to make sure that you identify if that's the case and that you record that new SBITA if it qualifies. So now let's discuss how GASB 51 and GASB 96 could interact. I think I went one slide too far. So most of you are familiar with GASB 51. You're getting more familiar with GASB 96. In GASB 51, it addressed the accounting treatment for intangible assets. So within GASB 51, it talked about treatment for internally generated software. And that means that it was a little bit vague, and some of you likely capitalized projects using GASB 51 guidance that now qualifies as a SBITA under GASB 96. So now what do? So if you previously capitalized a subscription because you thought it was applicable under GASB 51, you're going to need to dispose of the asset as of the transition date for GASB 96. So that, like Kelly mentioned before, most of you are 630, that would be 7/1/22, unless you're comparable 7/1/21. And you want to make sure that you record the appropriate entries back to that earliest year presented. This can get a little bit messy if you're doing comparative statements, because you're going to need to restate your net position in the earliest year presented, and then unwind your amortization expense in the prior year income statement. In addition, if you implemented the software in previous years and you're already depreciating it, so you already placed it into service, then now you have to fully unwind the depreciation and record a net position restatement, just like you did for capital leases. This can get kind of complex, but GASB made a really big deal about this for leases and noted that just because it takes a lot of time and effort doesn't mean you can get away without doing it. Make sure that when you switch over to GASB 96, if you have any projects that fall in this category, make sure that you also do the restatement to catch up amortization from any prior periods. So the net impact may or may not be a lot, but there's two primary differences that could occur that would result in a significant difference in your amortization. And that's under the GASB 96. You're not just amortizing over the useful life, you may be amortizing over the shorter term, since you have to choose the shorter of those two things. So you may have had something that you capitalized under GASB 51, you're now depreciating it over 20 years because that's how long you expect to use it, but your actual SBITA is for a 5-year term. You have to consider whether that is the full term of your SBITA. Again, we'll talk about those annually renewing contracts in a little bit, or if it's 5 years that you should be amortizing over total. You're also going to have differences for the inclusion of the liability and the asset amount as well when you record under GASB 96.
Kasey, if I can add just one piece. Yeah. I was in the room when they presented at GFOA when GASB did and talked about this idea of just doing a prior period adjustment versus truly doing the calculations. There's a piece in GASB 96 that basically says you have to restate to the previous to the earliest year presented when practicable. How that's a word, I'm not sure. But they made a really big deal about saying, even if it takes you 50 hours to figure out those calculations, that is not the definition of practicable. We were a little bit loose on this with GASB 87. I know there's probably a couple of clients on this webinar that we allowed to not restate all the way back. But because this is impacting predominantly your liabilities, and because you may have, it's really factoring in if you had GASB 51 assets and GASB 96 assets, that if that's a pretty significant amount, then you really do need to take that all the way back. We're not going to just say, oh, well, that's fine, you don't have to go back. So really focus, it's July 31st. You've got good time before your audits happen. Really take the time and go back and restate if you're presenting comparatives. Just wanted to put that in there for my audit clients.
Fair enough. So what if you have a project that's capitalized under GASB 51 and now it's an immaterial SBITA? No subscriptions qualify for capitalization under GASB 51. So regardless of materiality, you have to dispose all of the subscriptions that you previously recorded under GASB 51, even if it's not going to become a SBITA and have a liability and an asset under GASB 96. You're just going to dispose of those, write them off, and get them out of your GASB 51 work in progress accounts.
All right, let's walk a little bit through project costs. This is a key concept in GASB 96. This is a part of what was there in GASB 51. There are 3 stages of implementation costs that get incurred with a subscription. Notice that the one in the middle, stage 2, for the initial implementation costs are the only ones that get capitalized as a part of that intangible right to use asset. These costs include consulting costs. You know, for some of our clients, you hire me and my consulting team to help with ERP issues, or, you know, in some cases, we're helping to implement DebtBook. We would be one of those consulting costs. It could be, you know, if you choose a Tyler Technologies product and they have an initial upfront, more like a project-based cost where it's you know, you pay for what you use during the configuration and implementation of their ERP systems. That is a cost. If there's additional testing, maybe you hire a third party to assist with your data integrity testing or migration testing. The key one too, that a lot of folks forget, is your staff augmentation costs. So if you if you bring in maybe temporary or part-time help, or maybe a consultant to be able to take care of the day-to-day so that your team can really focus on configuration and testing of your new software, those costs qualify as initial implementation costs, because go back to your concepts for capital assets. It's all of the costs that it takes to place the asset into service. And had you not hired those temporary staff to be able to augment and allow your folks to focus on the software implementation, you probably wouldn't be live when you are. So I want to point out a question. Actually, a couple of these questions have come up recently. I have a few clients that are doing implementations of software, and they brought up whether or not their employee costs for their full-time employees can be capitalized. I will say, as a general rule, the staff costs are already a part of your departmental costs. They're already in your operating budget, and they're not avoidable costs. If you were not implementing the software, you would still have incurred those costs. They would just be working on other things. So as a general rule, I would say no, those direct employee costs don't count, but I'll caveat that. If you have part-time staff or temps, I mentioned, if you incur overtime, and that's an additional cost that you're maybe paying your hourly folks, those will count. And if you do have someone, maybe you're using an MA or someone who wouldn't normally be assigned to the implementation, and you want to capture those costs, if they are fully tracked on a separate timesheet and they're auditable, this is the auditor hat I'm putting on here, then you can include those. It's really a management decision, but you have to be able to provide the support. We're going to test this just like we test capital assets. So we're going to pull timesheets, we're going to pull invoices, and if they're not separately identifiable and we can't detail test it, at the end of the day, that's a scope limitation. And if you still were hard pressed and wanted that to be included, we would have to modify our audit opinion in order to allow that to flow through. And I know none of the 879 people on this call want that to happen. So just make sure you're really focusing on the costs that are directly associated and standalone for your implementation. You want to launch polling question number 2? And I'll keep going through. All right, so here is a real life situation that I know a lot of you guys will face in future years. What do I do if I incur costs after my go live date? So I'm putting this one a little out of order. We're going to go into a key piece of this go live date in a few minutes, but technically your go live date is more than likely your true SBITA commencement date. And it says that you can only capture costs as a part of the subscription up until that date. So let's use our ERP system as an example. You have configured GL, you're live in GL, but payroll is just as heavy of a lift. And you're still configuring your payroll module. What do you do if you're still incurring those initial implementation costs after your go live date for GL, but you want to include your payroll? Hopefully everybody's keeping up with this. Essentially what you're going to do is you have to look to paragraph 40. This again is another management assertion. Management has to make the determination of whether or not those additional costs qualify as outlays that either increase the functionality of the asset or increase the efficiency of the asset. If you feel like you can support your position to your auditors, then you can absolutely capitalize those as additional project costs. And ultimately, you'll increase the intangible right to use asset. You'll see some journal entries in a few minutes that will help make the debits and credits make sense. But it essentially creates a new layer to the amortization of your right to use asset. So let's take a look at this, a real life example on the next slide. So again, we implemented our GL module. The initial subscription asset, which includes all of our liability, is $740,000. We start amortizing it as soon as our go live date hits. Then the second year of the SBITA, we incur another $100,000. That's for the payroll module. In this example, we're assuming that we can support that it qualifies under paragraph 40A. Therefore, we're going to capitalize it as a part of the subscription asset. The liability doesn't change. There's no additional subscription, either monthly or annual subscription costs. So we debit the asset and ultimately remove it out of our expenses. And then it creates that new layer of amortization. So you can see in 2024, we were amortizing the $52,858. In the second year, we're amortizing $105,714 for that initial subscription asset. But now we need to add $14,286 to it for that second layer for the additional implementation costs. The same theory exists for this additional cost. It's amortized over the shorter of the remaining useful life or the term. So I'm going to put a little plug here for GASB 94. This is one of the key concepts in GASB 94 when there's improvements to a government asset that your operator pays for. So this idea of this kind of waterfall looking amortization or a tiered amortization is becoming a little bit more common when it's associated with the same asset. All right, materiality. I cannot tell you how many clients have been calling and asking me about what level of materiality makes sense. The reality is the board specifically omitted the concept of materiality. And I think it was because they realized it was a little bit dangerous. There's differences in materiality between your organizations and your auditors. You know, auditors use materiality to define a threshold with which they will test transactions. And there are numerous thresholds that we use. Just because something falls under that threshold doesn't mean it's not material. So one of the things that you've heard me say is tread with caution. I did a presentation in May and said it like 10 times. If you use materiality, be careful. I'll give you two reasons. First, there's really no correct way to look at materiality. You have to look at the totality of the transactions over the life of the term. So I've had clients look at it at the annual payment. Say the annual payments are $50,000 and you're talking about a $50 billion organization. That's tiny, right? But you don't look at it on that monthly or annual cost. You have to look at it as the total net present value of all of the future payments that ultimately constitutes your subscription liability. But let me throw another wrench in. Liability is not the only thing that results from the implementation of SBITAS. You also have this right to use asset that has its own materiality. You have the transactions that flow through your income statement, like your revenues and expenses. They also have their own materiality. There's also this key concept between materiality and capitalization threshold. I also think that that's dangerous because if you increase your capitalization threshold, what's significant for your capital assets may be higher than what's significant for your liabilities. The biggest problem is that your intangible asset includes far more than just the liability amount. It includes all of those initial implementation costs. So if you're solely looking at the liability amount, I'm thinking now, my clients who are implementing DebtBook. DebtBook doesn't have your initial implementation costs unless you give it to them. So you might have something that's maybe, I have a client that uses $100,000 as their threshold. You might have a subscription where the total subscription liability is $80,000. But as soon as you add in those initial implementation costs, it could very easily take you over that $100,000 mark. My personal, for my consulting clients, my personal recommendation is to include everything, take everything across the finish line for GASB 96, meaning you've pulled your implementation costs, you've calculated your liability, and at that point, you can consider if something falls below the threshold that you've previously set. The final comment I'll make about materiality, because clearly for me, it's a big deal. The final comment is most of us tend to look at materiality per transaction. But if you have 10 transactions that you've deemed immaterial, be really careful because the totality of them together could become material for your auditors and could end up with one of two things. It could either end up with a pass adjustment. And that's that little chart that shows up in the client rep letter and in the audit communication letter. Basically, it says, hey, you should have recorded these items, but you didn't. They weren't material, so we were okay with it. It'll either be put in there or absolute worst possible case situation. It's the 11th hour. We realize the totality is exceeding what we're comfortable with. And now you're going all the way back and having to put all of this in. Include everything and talk to your auditors. And if you guys agree together, then I would say that you can apply a concept of materiality, but just be really, really careful. It's better to include it up front and then take it out than not include it at all and have one of those worst case situations. Ms. Kasey.
So now let's talk through the implementation guide. So GASB earlier this month finally issued the implementation guide 2023-1. And in the implementation guide, they addressed several questions related specifically to SBITAS. So we wanted to make sure that we covered those here today. So the first question was, is a licensing agreement for a vendor's computer software that automatically renews until canceled a licensing agreement that provides a perpetual license? This was the question that we referenced earlier related to how do you determine your subscription term and what this particular question could mean for some of your subscription agreements. So GASB said no, that they are not considered, that automatically renewing contracts are not considered perpetual licenses. So what does that really mean for you? For most of our customers, it's meant that they have a lot more contracts that are qualifying as SBITAS than they originally thought. So we have a few questions here listed that you can walk through to help you determine if you have some SBITAS that qualify under this question. But basically, the most important thing to note is that GASB concluded that if these agreements go on uncanceled, so there's no cancellation by either party, and they're auto-renewing, they're not considered short-term and they're not considered perpetual. So you do have to record them. What this also creates is another management decision. So now you have to look at each of those periods. Let's say you have an annual auto renewal. If you don't plan to terminate under that auto renewal, you have to determine how many of those auto renewals you think you're going to use before you terminate. So management now has to decide, okay, if I have an auto renewal and it goes on in perpetuity, how long do I actually expect to use this software so that I can actually determine a subscription term? It's going to be really important when you're going through these options to terminate the agreement and the reasonable certainty of those to assess all the facts that are relevant. So regarding the contract underlying IT assets, market demand, circumstances specific to your entity. One of the most common ones that we see are ERP systems. Since a lot of you work with the ERP systems daily, it's automatically renewing. Maybe you have a 3-year contract and it auto renews each year. You have to think about what is the likelihood that you're really going to want to go through another ERP implementation anytime soon? Highly unlikely, I'm sure. So each one of those years that you expect to use it, let's say you expect to use it for another 10 years. Well, then you're reasonably certain you will not terminate that contract for 10 years. So that's going to be your subscription term. You have to consider all of those periods that you do not plan to terminate these auto renewals. I do want to touch on implementation. So for any of you that are DebtBook clients, if you are currently in implementation or you will be in implementation coming up, we have already applied the implementation guidance here to make sure that we identify for you any contracts with these auto renewals, so you know to go in and identify how many of those periods you expect to be included in your term. But for those of you who were not in progress as of the beginning of this month, so prior to the implementation guide coming out, it was completed over what we knew up to that point. So make sure you go in and take a look at those short-term SBITAs that you may have in the application and just identify if you need to consider whether or not they have those auto renewals and estimate that time frame if they do.
Kasey, before you move forward, I just want to address, I saw a comment pop up about it being in contrast to what GASB had mentioned at another conference. And Kasey and I will tell you, we know. We have been struggling with this since the exposure draft of the implementation came out a long time ago. When we saw the answer to the question, I think Kasey, you and I probably started talking about this in April when they first initially issued the draft of this implementation guide. I know it's in contrast to what you guys are hearing, and you are absolutely welcome to submit a technical inquiry on GASB's website. We struggled with this and we contacted GASB ourselves. We've had a number of conversations with them over the course of the last couple of months trying to clear a lot of this up. Yep. Ultimately, think about it. It makes sense. If you have a contract that never ends, or there's a specific trigger that has to happen in order for it to be canceled, does it really make sense that you're not going to have any future liability and no asset on your books? To me, that doesn't make sense. It's kind of that concept over form thing. So if you have any questions, by all means, you can read. There's a couple, we'll have a slide that has our contact infos in it too, but I would recommend submitting a technical inquiry. Many of my clients have argued this, but at the end of the day, the guidance is the guidance. There's nothing that we as auditors or Kasey as a software development company can do about the GASB's take. I will make a side comment, and GFOA will probably kill me for saying this, but I had a conversation with a member of GFOA at the GFOA conference this year specifically about this. And GFOA posed the same question to GASB because they felt like this contradicted what was in GASB 87. The comment I got back from GFOA was that we all got leases wrong, that this was how we were supposed to look at leases too. So I'm not doing a retroactive review of it. I can't tell you how many clients got it right or got it wrong. But this is kind of one of those key concepts that is different than our previous understanding. So just make sure you really go through it and have a good grasp on it before you finalize your implementation and give everything to your auditors.
Yeah.
Thanks, Case.
Yep. So then the second question that they posed was, for purposes of determining the applicability of Statement 96, do software as a service, platform as a service, and infrastructure as a service contain a combination of IT software and tangible capital assets? Yes. So not only do softwares count, but platforms count and infrastructure counts. And some of you might be wondering, well, what does that even mean? So platform as a service and infrastructure as a service really is often going to be handled by your IT department. So it's going to be really important that you get in touch with them, that you find out if they use any of these examples that we're showing here or anything like that. It's basically cloud computing models for on-demand computing resources and third-party providers. You just want to make sure that any of these agreements that your IT department might have entered into are included if they fall in these categories. This is an often overlooked one because it's generally very IT specific, and so it's not always going to make it to the accounting department or be something really visible. So make sure that you check with them and you find out if you have any agreements like this.
All right. So this final question that was in the implementation guide is a big one and probably the most confusing. It's also one of the main reasons we're here today, because Kasey and I had to do a ton of research and deal with GASB to try to figure out not only how to implement it, but how to do it for future projects. So the question talks about a 6-year contract, not term, don't get confused, a 6-year contract that has no options to extend or terminate. The initial implementation stage is not completed until the 2nd year. What is the subscription term? You would think that it was 6 years, and that's how a lot of implementations were done. However, the term in this example is 4 years. And this is because the definition of the commencement date is a little bit ambiguous. So Kasey, if you want to skip to the next slide, it'll show a graphic of it. Oh, sorry. Let me first tell you what this means. First, any of your subscription costs before the commencement date, which I'll go over in a second, any of those subscription costs get accumulated. You're not going to record the liability as of that first contract start date. Up until now, your commencement date has always been July 1st, 2022, or for leases, it was July 1st, 2021, depending on your year-end date. This key concept of your commencement date not equaling your contract date is probably going to be the case on a prospective basis for 90% of your subscriptions. So right now, all you have to focus on is whether or not you have a subscription agreement or a software that you're currently implementing. If it was implemented in the past, you don't really have to worry about this much. But if you're currently implementing it, this is going to be a really big deal. If you use DebtBook as an example, maybe you signed your contract with DebtBook on January 1st, 2023 of this year for subscriptions. You paid for the white glove service. Say that white glove service was $10,000. I know it's not, but pretend. We know that white glove service cost is going to be a part of your implementation costs, and your annual subscription amount is going to be separate from that. If you didn't send them your subscription documents until May 1st, they haven't started configuration at all. Say they finally give you your organizer with their 90-day time frame, you don't get your organizer until, say, August. You're now after your fiscal year end. You don't have a subscription until go live, which means the day that they hand over the reins to you. So if you've gone through all of your meetings with them, they make you in charge and you can make all of the changes to the software. That is your go live date, which means that becomes your commencement date for your term. Your term does not start, in this example, your term does not start January 1st. This will impact your project costs because you're going to accumulate all of your software subscription costs as a part of your project costs until go live. Next slide. So I mentioned you accumulate the costs. I'm giving you all kinds of guidance here so you can go back in and if you need to, you can draw your conclusions. Paragraph 26 basically says that all payments before the commencement date of the subscription, as well as payments made for the capitalizable implementation costs before the commencement of the subscription term, should be reported as a prepayment. Super confusing. We had to call GASB about this because it did not make any sense. It contradicts GASB 51, and for the asset side, they're supposed to be similar. What GASB ended up saying is they intended for it to be treated very similar to work in progress or construction in progress. I've been calling it subscription in progress. So we're going to go through the journal entries in just a second. We're going to fly through the journal entries. But it's important to know that these accumulate in your government-wide statements, or if you're a full accrual entity or they're in an enterprise or internal service fund, just put it in that work in progress fixed asset, capital asset. I want to make a key point on this piece because most software solutions, totally fine to launch. Answer your questions, folks. Polling question 3 is up there.
I got a little ahead of you, Kelly. Sorry.
You're totally fine. Most software solutions are not currently structured to handle this right now. They're not structured for you to do the journal entry to accumulate the work in progress. They're really only built for you to manage it once it qualifies as a subscription and you determine that subscription liability. So just pay attention to this. Kasey, do you want to talk to the group about briefly how you guys want it handled for DebtBook?
Yeah, absolutely. So I can show a little bit later on in the presentation, right after the example, it'll show where you can add a project. And what you can do is you can accumulate all your costs in a project without it becoming a subscription. And then once you place it into service, your software's in service, you create a subscription and you can assign all those costs to it, and it will give you all the necessary journal entries. So it will give you the journal entries while it's in project status, putting it in that WIP account, and then it will give you the appropriate journal entries once it converts into the subscription.
Beautiful. Thank you.
Sure.
All right, let's get into these examples. All of these examples are in the slides. For those of you asking, the slides will be emailed at the end of the presentation. I'm going to breeze through these journal entries and give you really those key concepts at a high level. So for the expenses, what do you do with them? Once they're live and we officially have that commencement date, you're basically putting your asset into service. The subscription payable gets recorded under, why do I feel like these are out of order?
Do you want me to just go to the next one?
Yeah, go to the next one. I think that one accidentally got scooched up. That's supposed to be the end. Okay, example. Lots of information on this slide. Disregard the details of it. Essentially, what I want you to know is if you're in the middle of implementing a software solution during your transition date, when GASB 96 becomes applicable, you're accumulating all of these costs in that work in progress. So if you're modified accrual, you're going to record your capital outlay just like you do with fixed assets. You're going to record a credit to, sorry, these are all, that should be over there. We'll fix it in the PDF copy that gets sent out. They're not lining up correctly. So you're going to debit capital outlay.
Yep.
And then this is really a reclassification entry. You want to credit the expense account where everything was normally recorded. So your subscription payments are probably going to end up being in an operating account somewhere. It's not natural for you to record that in a capital outlay expense account. Make sure everything ends up kind of in the same category, account category where you put all of your CIP, whatever your account numbers for those are. On the government-wide side, you're going to pull them out of capital outlay and capitalize them as a capital asset, just like you do your construction projects. These are just like that. If you're on a full accrual statement, say it's an internal service fund or an enterprise fund, just like your CIP as well. You're going to end up debiting the subscription in progress and credit the expenses wherever they're recorded. So that's for this initial, you're still in the middle of implementation. You have not gone live yet. You're just accumulating it into subscriptions in progress. Next slide. So now you have another, you're still not live in this example. You have another 110,000 that you've accumulated in implementation costs. You've paid another year of your subscription costs. All of these expenses get included in the work in progress, subscription in progress asset. Same exact journal entry as the previous slide. By the end of it, you should have work in progress of 180,000. But again, there's no subscription yet. There's no liability, you just have an asset. All right, the next slide is where we start to get to having a subscription liability. So say we finally go live on July 1st, 2024. We've already implemented GASB 96, everything's sitting in work in progress. You need to record that work in progress or subscription in progress journal entry, just like the two previous slides, up until January 1st, 2024. That's finishing the accumulation of your project costs, including any additional subscription costs that have already been paid up to that point. So at the very end of this, next slide, Case, you should have total implementation costs, which include those previously paid subscription costs of 240,000 sitting in your subscription in progress account. We've done the analysis through DebtBook. We know our subscription liability totals 500,000. And now we need to record the actual subscription. This is what comes out of DebtBook, but I'm giving you the entries here just in case you're not using a software solution. So first we need to record the capital outlay and other financing source for the subscription liability. This is modified accrual. So if it's a general fund, whatever it might be, it just flows through the income statement. Super easy. Then on the conversion to our government-wide statements, we need to pull it out of other financing sources and show the subscription liability. That's a normal conversion entry from your fund level to your gov-wide. If your auditors prepare your financials, they will probably do this journal entry for you, but you still need to tell them what that subscription liability balance should be. Then on the flip side of that 500,000 in capital outlay becomes a capital asset. So we need to add that to our capital assets, that intangible right to use asset for subscriptions. And we need to reclassify, just like construction, you're placing the asset into service. So you have a transfer from work in progress to a depreciable asset. In this case, we're transferring it out of subscription in process into intangible right to use. And this is when you trigger amortization. So on the next slide, at the very end of all of it, January 1st, 2024, our intangible right to use asset is 740,000 and our subscription liability is 500,000. I did want to note paragraph 27 talks about the subscription asset being amortized in a systematic and rational manner over the shorter of the subscription term or the useful life. Kasey mentioned this a while back and a few slides back. More than likely, it's going to be that subscription term, because technically, if you keep paying, the useful life of the asset will almost always be longer than that initial term. All right, let's go to the next slide and let me just go over the one that we ended up skipping over a second ago. What does this mean to you?
The first one?
Yeah, you will not have a subscription liability while you're in the middle of implementing a software. Super, super important. You're just going to keep doing it. Think of it just like fixed assets. And then as soon as you place that asset into service, not only do you need to move it to a depreciable asset, but you have that liability. Paragraph 59 talks a little bit about how everything flows through the income statement, when it flows through the income statement. But at the end of the day, it's making sure that you're recording it, in line with when the costs are incurred. So you're flowing that capital outlay through at the fund level as you're incurring it, accumulating it in government-wide statements. Yes, ma'am.
Excuse me, I need to launch the last poll, so keep talking. I just want everyone to know.
Yep, you're good. Go. Sorry, I was actually, oh, we're almost done. Case, you want to do that last software implementation slide?
Oh. So this was just what I was referencing earlier, where you can see that there's a create new project space if you're using DebtBook, and that is where you can accumulate all those costs so that when you create your new subscription, when it's in service, you can apply all those costs that are related to that subscription. So it's a place to be able to manage the project and have it all connect the way that you need it.
Hey, Mark, I'm going to answer your question because I just saw it pop up, and I'm sure there's probably at least 500 people on the call asking the same question. You are going to record it as capital outlay until go live. You're going to record it as capital outlay in your fund level statements, and you're going to accumulate it as work in progress. The payments made before go live they're not a part of the liability. They're a part of your implementation costs. So when you go back through, I know I breezed through those slides there, you'll see them in the slides, and you'll see that a part of it, I think it was maybe 40,000 per year, was the subscription costs prior to implementation. So I just wanted to point that out. All right. I'm gonna wrap
So
it
we
up.
covered a lot of ground, a lot of unique situations, but hopefully this was helpful for everybody. Hopefully you have a better understanding of how GASB 96 interacts with 51 and 87, better understanding of your project costs and some of these complex scenarios, and also with the implementation guide provided that was recently issued earlier this month.
So I do want to point out, for those of you that are still on the webinar, we are doing an in-depth detailed webinar on GASB 91 and GASB 94. I will tell you GASB 94 is more complex than you think. Any of you that have golf courses, parking structures, any organizations that have a third party that's basically operating on their behalf, and the third party is collecting revenue and remitting it to you, you will likely have something under GASB 94, even if it's only a footnote disclosure. So keep an eye out for that on Thursday, August 17th at 10 a.m. You can sign up on LSL's website, which I think is maybe on the next slide. Maybe not. It's www.lslcpas.com. And then if you have any questions, Case, if you want to forward feel free to reach out to DebtBook or LSL. We're here to help you. I know there's a lot of you on this webinar with a lot of questions. We've just done so many implementations, and there's been so many unique circumstances that we felt like we really needed to bring it to you guys so that at least, if nothing else, it plants the seed that there are a lot of unique circumstances to be aware of. We'll get the webinar, the slide deck updated, get that little formatting fixed, and then we'll make sure it gets out with the rest of your information.
And actually, a couple of you that posted in the chat that you wanted to know the correct answers to the poll. Unfortunately, we didn't have time to go through all that, but we do have a note of who you are, and we will send you the correct answers.
Awesome. Well, thank you, everybody. We appreciate your time, and thanks for spending an hour with us talking about what Kasey and I are passionate about. And we will get those answers sent out to you guys on the other questions as well. And if you have anything for us, feel free to reach out. We are here to help.
Yes, and just wanted to say there's still people asking. Yes, you will receive the slides later today and a link to the recording of this presentation. And you know what, we're going to send everybody the answer to the poll questions because it looks like a lot of you are asking for that. So we want to thank all of you so much for joining us today. There was a lot to cover. And really quick, Kelly and Kasey, a couple of people asked, will there be an encore follow-up presentation to this webinar? And I said, stay tuned.
Maybe.
Maybe necessary.
All right. Thank you so much all, and we will see you next time. Thank you for joining us. Bye-bye.
Thank you, everybody.
All right.